Hello and welcome to Shanghai Eye. Here on Dragon TV, Monday through Friday, we'll bring you stories to decode and explore China. I'm Chen Xuan.
Hi there, I'm He Jian. We will look at business, tech, urban life, arts and culture, and sports, and everything going on here in the city. Gold and silver prices have been under the spotlight a lot recently as prices surge dramatically. Most recently, prices of both precious metals hit record highs as investors reacted to the treat by U.S. President Donald Trump to impose fresh tariffs on 8 European countries, opposed to his proposed takeover of Greenland. And Zhang Shixuan talked to Johnny Tevis, precious metals strategist at UBS, to find out more about the precious metal market.
What surprised you the most in 2025? And my response to that has been the price action in precious metals in December.
The extent of the rally has proved a surprise to most.
And I think even the most bullish market participants were still a little bit surprised to the extent and the speed at which prices rallied in the past month or so.
Both precious metals have been breaking records for a while now, triggered by macro factors.
The momentum remains strong.
What is UBS's recommended strategic allocation to gold?
5% is a good level as a diversification into gold.
To learn more about the gold and silver investment market, I sat down with Johnny Tevis, precious metals strategist at UBS. Ms. Tevis, thanks for joining Shanghai Eye.
Thank you.
Given the recent surge in both silver and gold prices, what do you see as the primary driver in this current rally? Is it more about geopolitical safe haven demand, the monetary policy outlook, or the physical market fundamentals?
The rally has been, in general, a combination of several factors. For gold, it's really been more about diversification that has been driving prices over the past year or so. And I think that has spilled over into silver and other precious metals. This need for investors to diversify their portfolios and especially to diversify into hard assets. The most recent run-up in prices as well, we think, reflects an increase in investor activity. I think that has helped kind of accelerate the move, especially during the period towards the end of last year where liquidity tends to be a lot thinner during the year-end holiday period. There has been an element of physical liquidity conditions also kind of having an impact on prices, and we saw that in gold at the beginning of last year. We saw that a little bit in silver in the fourth quarter, and we think that this is something that could continue to be a theme into 2026. So in addition to gold and as an extension silver being driven by macro factors and what's happening in the macro landscape, we think that investors should continue to be quite mindful that at the end of the day, gold and silver are also physical commodities. So we need to keep in mind these liquidity issues as well.
How's UBS modeling the path for the U.S. real interest rates and the dollar? And what is your base case gold price target for the next 6 to 12 months?
We're still expecting a couple of rate cuts this year, and that should ultimately be supportive for gold prices. Despite the fact that gold's correlation with real rates has been a lot more unstable in recent years, we still think that it matters for gold's ultimate path, because at the end of the day, real rates represent the opportunity cost of having that position in gold. Our view on the dollar is a little bit less straightforward as far as gold is concerned, because we're not necessarily bearish on the dollar this year, but we think that gold's appeal is beyond just the dollar, right? We think gold is currently being viewed as an alternative to fiat currencies more generally, especially with growing concerns about fiscal and debt sustainability across many different economies. So from that perspective, we think even if the dollar strengthens, gold can also continue to strengthen. And we think that the gains in gold will be a little bit more focused on the first half of this year. So for gold and by extension silver, our base view is that it will be a year of two halves. The first half of the year or so, we continue to see the market making new record highs. Towards the end of the year, so the second half of the year is when we start to see the bull cycle in gold maturing as the Fed nears the end of its easing cycle, we think this will also coincide with the bull cycle in gold also nearing its end. So we think that prices will taper off in the second half. In the first 2 quarters of the year, we have 47.50 as a target. We're very close to those levels now. That's basically an average that we expect, so that implies that the market could test the 5,000 level, particularly if concerns around Fed independence start to gain more momentum. And towards the end of the year, we have a year-end target of 4,500, so we think that the market will start to taper down.
With central banks, especially from emerging markets, continuing to be strong buyers, do you see this trend as a permanent structural shift in the gold market?
I can't see them buying gold forever. At some point, they will also reach their target allocations in the same way that investors will eventually also reach their target allocations. But our view is that for now, the trend is likely to continue. So our expectation is that the volume of purchases from central banks, sovereign wealth funds, other official institutions will remain at historically high levels. So well above the average that we saw prior to 2022, which was about 400 to 500 tons. They have been buying over 1,000 tons in the previous few years. Last year, as of October, the sector was on track to buy 850 to 900 tons. So that type of slowdown is what we expect to continue in the coming years.
Silver has significantly outperformed gold recently. To what extent do you attribute this to its industrial demand profile versus a pure speculative catch-up play?
The performance of silver, particularly in the second half of the year, we think has really been driven by kind of investor activity increasing and investor interest increasing in silver, partly because of kind of relative value plays, silver kind of not really keeping pace with the rally in gold. Also silver, even as it outperforms gold, it still is at a much lower price point, so it's much more accessible for many investors from that perspective. So we think that it's really investor flows that tend to drive silver prices rather than the supply and demand fundamentals. We do think that supply and demand outlook helps because the fact that we are expecting to see continued deficits in the market does also help investor sentiment. So it feeds into the decision for investors to take positions in silver.
With volatility picking up, what are the key downside risks you're monitoring that could trigger substantial correction in precious metals?
For gold, the key downside risk that we see is really if there is an acceleration in growth, especially out of the US, potentially if we start to see AI productivity gains and that drives growth, then it puts the Fed at a position where if inflation remains high, growth is strong, they can tighten policy, and in that scenario where the expectation shifts towards rising real rates, then that changes the whole narrative for gold. So in our view, that's the biggest downside risk for the bullish outlook. Another potential source of downside would be if there is a sharp correction in equities, and this leads to investors needing to find liquidity. So gold in that sense will act as a source of liquidity. But if that's the case, I think it will be a buy the dip opportunity because I can see that gold typically does well in the aftermath of that sort of dynamic. And then finally, another potential downside risk would be if central bank and official sector purchases are a lot lower than expected. And by a lot lower, I mean that it's well below even the average that they were buying prior to 2022. Not because that in itself is negative for gold, but I think it will make a lot of investors nervous because the official sector buying has been such an important part of the narrative for gold. For silver, in the very near term, I think any announcement regarding the Section 232 investigations, if it's a case where there's confirmation that tariffs will not be applied to silver, that could create some near-term headwinds. And given that silver doesn't have the official sector buying that gold has, it means that it doesn't have as much support. So that does mean that the pullback in silver could be much deeper than what we've seen in gold. So that's something that I would be more cautious of. I think silver in general has been or tends to be much more volatile than gold. In particular this year, I think think especially with the increased investor activity and increased short-term investor activity, I think market participants need to be mindful of even greater volatility in silver.
Now to our Q&A section. Abdul from Malaysia asks, I have a shipment of personal effects arriving at Shanghai port. Could you please advise how an individual can complete customs clearance? Well, first of all, according to China customs regulations, your shipment must fall within the approved catalog of personal use items and be in reasonable quantities. You may handle customs clearance either in person or through a customs brokerage company authorized by you. However, you must first obtain a long-term residence permit in China before you can declare personal effects for import. Your first-time import of eligible personal effects can be exempt from duties except for motor vehicles. So for more information, you may consult the Huangpu Customs either in person or by phone.
If you got any questions for us, you can find us on all the socials and all the content online as well.
We'd love to hear from you, and do join us here on Dragon TV Monday through Friday.
Thank you for watching. See you next time.
See ya.